Good evening. My name is Edniel Marrero with my research proposal video on human AI collaborative investment strategies. So let's go ahead and get started. For our introduction and rationale for this study, I've noticed a few things that inform my research here. First, that artificial intelligence technology is capable of large and complex dataset processing. Artificial intelligence is also being used to analyze capital exchange markets, which would include your stock market, your bond markets, your credit markets, your commodity markets. All of those would constitute capital exchange markets. Artificial intelligence is also being used as a personalized assistant and advisor for more people on a continuing basis as time goes on. So, this proposes some interesting questions for research. Is human collaboration with artificial intelligence able to create personalized investment planning and advice next? So, as an example, could I prompt an artificial intelligence specialized in investment advising on a particular financial situation that I'm currently experiencing, and how should I balance my portfolio according to that scenario, which we'll continue to investigate later. Also, can AI help remove human behavior and irrationality from investment decision making? Behaviors such as like a fear of missing out or of cutting profitable trades and investments too quickly or too soon. These would be behavioral irrationalities that have impact on price action in these markets. Also, could training data and communication contaminate artificial intelligence with cognitive and behavioral biases? That's both from the human operator as well as potentially from the corporations that design and provide the training data for these artificial intelligence models. So, in our literature review, we found that humans generally don't trust AI generated advice unless it is verified by a human domain expert. This would be your financial advisor, investment advisor, professional investment planner. Uh, Typically, humans are much less likely to purely trust AI advice on its own face alone due to the presence of hallucinations that could distort the accuracy of particular pieces of advice. However, investors with a really high risk tolerance tend to also use AI to create investing strategies that exploit market price inefficiencies. These market price inefficiencies are created by human driven emotional or biased trading behavior. As well as the improving conversational abilities of AI, it's deepening personalization to the human user. This presents a concern that this interaction, this communication, could contaminate the artificial intelligence and create a strategy that is inherently already susceptible to bias because the communication and the training data was already contaminated with the bias from humans to begin with. So, agentic AI, which is a recent advancement in artificial intelligence, is a type of artificial intelligence model that is capable of autonomously watching market conditions and executing investment strategies utilizing a array of tools. So if an artificial intelligence model is a tool in and of itself, an agentic AI model is a specialized artificial intelligence capable of utilizing various tools that are available to it, both online and proprietary. And in this case, this would imply that financial firms are utilizing these agentic artificial intelligence models in order to gain an advantage in capital exchange markets, which is evident by research conducted by Akaria et al. 2024, Sigma Seti in 26, and Shao et al. In 24, as well as Sigma Seti Senekala 26. Didn't want to not credit him there, unintentional. So let's continue on to the purpose and our research questions for this study. Our main questions here are: can artificial intelligence create personalized investing strategies through human collaboration? Which artificial intelligence models create the most effective personalized investment advice? Can AI find and flag trading behavior that's cognitively or behaviorally biased? And can AI help educate and improve the skills of new investors? If this is all to be investigated, another thing of note to keep in mind as we continue our research is what the current capabilities and limitations of AI is when used to create personalized investing strategies. So, what are those limitations, these strengths, these weaknesses, is what we want to find out. So, for our disciplines explored through our lens of interdisciplinarity, interdisciplinary research is the investigation of theories and methodologies from different disciplines in order to solve a larger complex problem. And this is because individual disciplines and their research proposals don't really focus on forming, identifying, and devising connections between other disciplines. It's very narrow focus. So, an interdisciplinary researcher helps bridge all of these connections together in order to solve large, complex problems that would be inefficient for one single discipline alone. And so, what I found was that human AI collaborative investing strategies are typically a combination of methodologies and theories derived from computer science, sociology, and finance. Computer science for the methodology of how the AI learns and takes information from its environment, from the field of sociology in terms of how we communicate, interact, and our perceived biases in terms of artificial intelligence and even markets. And then, of course, finance. How exactly are investments made in these markets? How are investment strategies typically curated for a personal financial scenario? So, human and AI collaborative investing strategies must define how these capital exchange markets work, which through research and our literature review, we found that it's typically through asset exchange dynamics. We should also understand how investors are vulnerable to cognitive biases, make sure that the AI understands that, and then make sure that the AI utilizes its deep reinforced learning strategies in order to continually update and balance its portfolio congruent to current market conditions. So, for our theoretical framework, we took behavioral finance theory proposed from Al Mansour's et al.'s 23 study on Saudi Arabian and Middle Eastern markets, which states that human investors are susceptible to several cognitive biases that alter their perception of risk in the markets. You'll typically see this in terms of herding behavior, where investors will go towards an exciting yet volatile investment that has seen recent profitability. So everybody will start piling into that. An example would be like cryptocurrencies and the sort of euphoric rally that those had, or the GameStop GME ticker during its rally, which caused disruptions in the finance industry. Now, there's also the disposition effect, in which investors tend to have a skewed perception on how they quantify their profits and their losses. Typically, the more profitable an investment becomes, the more fearful an investor may become to holding that, and they may be averse to taking a significant drawback, even if the asset will continue to appreciate in value over the long term. And that goes the same for the inverse, where an investor holds onto a losing investment in the hopes of it eventually turning around into profitability later on in time. Blue chip bias is typically a heuristic where reliable and historically profitable assets are prioritized for investment portfolios. This would be similar to your exchange trade funds that track, for example, high beta technology sector markets, or even just a index of the market. In a sense, is also a blue chip bias, where people will go into a broadly diversified ETF because it is the recommended means of exposure into the stock capital market. Now, there's also overconfidence, where recent success and profitability from an investor may distort their risk tolerance in the future, leading to them making riskier and riskier investment decisions. So, artificial intelligence may be able to help human investors update their portfolios by taking in the current market conditions as proposed in the deep learning regime from Sigma study and Senecala's study. And if we were to combine that with a personalized financial scenario from a human collaborator, then we may be able to produce a portfolio that is a lot more responsive and dynamic to the market conditions as well as the personal investment goals of the investor, which is collaborating with the artificial intelligence in order to create a more effective portfolio. So, in that sense, what we can do is by combining Al Mansour's methodology with Sigma Seti and Senecala's, is we can potentially create a human AI investment strategy that not only accounts for the current market conditions, but also can account for identified behavioral and cognitive biases within those market conditions, leading to a more efficient portfolio. So for our data collection plan, we'll use currently popular and publicly available artificial intelligence models such as ChatGPT, Claude, Gemini, Copilot. Perplexity even has a specialized financial artificial intelligence model. We're going to compare each model's proposed advice and rationale for a human-controlled investment scenario. So the prompt will be the same across each model. Therefore, we're able to see if there's any distinct deviations between the artificial intelligence proposed investment strategies. So, in that sense, we compare the deviations in these proposed investing strategies to if we were to change the preferred time horizon. So, how would these investment strategies change if the human collaborator, in this case, desires that the artificial intelligence optimize for profitable investments within the time span of a few days versus a few years? Finally, we'll compare the investment strategy proposals to benchmarks used by financial planners in order to determine how wide the deviation could be between each of these models and established norms when it comes to investor recommended allocations for their portfolios. Typically, these will be measured on a time frame in the lifespan of the investor. So, how you invest when you're 30 will be different than how you invest when you're 70 and in retirement. For our data analysis plan, we're going to be using the Perplexity Finance AI, Gemini 3.0, ChatGPT 5.3, and Claude Sonnet 4.6. So for our phase one, we're going to use a sterile account with no prior conversational history and provide the control human investment scenario in order to compare each model to the standardized investment planning benchmarks. And then on phase two, we'll also prompt each AI to create and design an investment portfolio based on the short-term strategies and current market conditions. We'll also use a portfolio backtesting program in order to verify the potential profit and drawdowns across each AI. Profit obviously being how much it made, but also drawdowns being how much devaluation occurred during that specific time frame when compared to a benchmark S&P 500 index fund, which would be either SPY or VOO. Further discussion. The human AI collaborative investing strategies can in fact be created when applying behavioral market theory and the learning market methodology for real-time portfolio monitoring as proposed by Sigmasetti and Senegala and Al-Mansour together, as depicted in our theoretical framework. So the purpose of the research was to investigate the applications of AI for creating human collaborative investment strategies. We did this by exploring methodologies from the disciplines of sociology, computer science, and finance. We also found that tools can be developed using AI to help educate new investors and improve productivity at financial firms. We found artificial intelligence trained on cognitive and behavioral biases of human investors required an interdisciplinary approach to design unique investment strategies. Again, the relationship and the interconnectedness between sociology, computer science, and finance. As for key limitations, future and specialized private artificial intelligence models, as of which private artificial intelligence models specialized for investment advising do exist. However, due to energy constraints, they tend to be prohibitively expensive to use. However, that being said, they may be capable of generating a more personalized investment strategies for a human investment scenario. Human AI collaborative investment strategies are capable of accounting for present market conditions, but the issue they chiefly have is that being the future is volatile and unknown, it may not be able to account or even predict future performance as significant unexpected market events could have an impact on the long-term reliability of the investment strategy. This would require long-term revising over time, which the frequency of which could only be understood through continuing research into the long-term reliability of these investment strategies. So, the implications of our research proposes a few key questions. So, if human AI collaborative investing strategies do become the standard for investors to get involved in capital markets, then how could that change how capital markets behave? If AI exceeds the skills of a human professional investment advisor, well, how could that change the relationship between humanity and AI when these white collar, high information expert fields become disrupted by artificial intelligence? What kind of impacts could that have from socially based on how we interact with artificial intelligence, but also even just how the markets operate? These are questions that will require continuing research. So, since there is evidence to show that financial firms are becoming more integrated with artificial intelligence tools and systems, how could that impact job disruption within the field of finance? Could the role of the investment advisor in these departments be at risk? So, our research here was intended to help educate and inform newer investors and professional investment advisors on how AI is being used now to create personalized investment strategies. Inevitably, professional investment advisors, if not already interacting with, will be interacting with individuals who have had their first experience with creating a portfolio through prompting artificial intelligence models, the ones that we investigated through our research. So, in conclusion, artificial intelligence is becoming more widely used to create personalized investing strategies. However, limitations still exist. Our intent was to gain a deeper understanding of the multidisciplinary connections used in artificial intelligence adoption and application for personalized investment strategies. So each model used, we found, provided a similar level of generalized investment strategies, in the sense that uh, for an individual who is unemployed, recently graduated, but looking to preserve their purchasing power through an inflationary environment, the general advice being focus on more shorter income dated credit investments. So this would look like having more bonds and fixed income vehicles in your portfolio compared to more speculative high risk investments such as technological stocks, uh, certain commodities, or semiconductors. Now, of note, artificial intelligence may be able to also identify and find the behavioral market inefficiencies posited by Al Mansour, but long term, more research is needed to gauge how truly accurate an artificial intelligence is at identifying these behavioral driven market inefficiencies. And finally, the effectiveness of human AI collaborative investment strategies in general requires continuing long term research. I'm confident that new methodologies will be devised in the future that will further lead to even more effective and personalized investment advice when prompted by a human financial scenario. So, for my connection to my own personal academic professional pursuits, my goal here was to hopefully achieve a deeper understanding of what AI is, what the latest advancements of the technology are, and how the technology can be used to solve complex and personal investment problems as AI is becoming more widely adopted, not only in the finance industry, but people in general are, despite initially being a little distrusting of artificial intelligence, they're generally becoming more comfortable in using the technology, especially if they have a shorter duration time frame for their investment time horizon. So, my research here hopefully is not only a showcase of my interest into the financial applications of artificial intelligence, but it can also serve as a source of education for new investors on the limitations but also the key strengths of AI when it comes to using it together when brainstorming an investment strategy. Well, my research is a demonstration of my interest in a graduate level of study for the field of financial technology and how AI can improve the field of finance. And for our complete list of references here on this final slide, thank you so much for your time and have a good rest of the evening.